Hi, and welcome to our second learning objective for Module 8. And this would be understanding the concepts to managing financial risk. So let's go ahead and jump into it. There are three basic learning objectives under this particular objective 2, and that's to discuss risk aversion, give an example of adverse selection and moral hazard, differentiate between market and firm-specific risk, and define the risk-return trade-off. So when we talk about risk aversion, most people we find are risk adverse. So they basically dislike uncertainty. The market itself dislikes uncertainty. We don't like things that we can't kind of foresee. And that's why when we see the Federal Reserve, for example, we try to anticipate what the Federal Reserve is going to do in terms of interest rates, because we don't like uncertain things. And that's why you'll see market volatility increasing as more and more uncertain events unfold around the global economy. So here's an example. If you're offered the following gamble, if we have a fair coin, if it's heads, you win 1,000, tails, you lose 1,000, how many of you would take this gamble? Well, if you're risk adverse, many people feel the pain of losing 1,000 would exceed the pleasure. And since both outcomes are likely, you shouldn't really take this particular gamble. But some people do. So when we take a look at risk aversion, it has to do with the utility function. And the utility is the want-satisfying power of a good or service. We tend to see that it is actually more painful for us to lose money than it is to gain money. So as wealth increases, we find that the law of diminishing returns, or diminishing marginal utility, kicks in. So let's just go ahead and graph this and see what happens. So if we look at this, and let me go ahead and draw the curve here. If we are at point A, I'm just going to go ahead and draw that. Basically, if we increase our wealth by $1,000, moving from point A to, say, point B, notice that the utility that we gain from the $1,000 is not as great as the utility that we lose when we lose $1,000. Studies have been done where individuals check their portfolios daily, and they tend to see that individuals that check portfolios daily tend to be much more sensitive to the losses, whereas those individuals that maybe check their portfolios quarterly or maybe even sometimes yearly will not feel the losses quite as significantly because they look at them in a more cumulative type of basis. One way that we can manage risk is through insurance. And there's lots of different types of insurance that we can get in the market. Sometimes we can use options trading, we can short sell, and this idea of insurance we're basically going to talk about has to do with pulling risk-averse people. And so the idea is if everyone bears the cost, then what will happen is then it is much easier to spread the risk around to several individuals than one person bearing the entire amount of the risk. Two concepts that are kind of important when we talk about risk, of adverse selection and moral hazard. Adverse selection basically says is that a high-risk person benefits more from insurance, so they're more likely to purchase it. I just purchased some insurance myself, and it's accident insurance. And the reason I did that is because I'm engaged in the horse industry, and I've had just about every broken bone that you can have. And so therefore I purchased this accident insurance because I do believe in the future I will be using it. And so I actually have practiced adverse selection. The other thing is people with insurance have less incentive to avoid risky behavior. So just this past weekend, I decided that I was going to teach a horse to canter who had never been cantered before. And this particular horse had put me in the hospital less than a year ago. So I did that knowing that I had insurance that would help me if I did get hurt. So again, practicing moral hazard. So we see these kind of things all the time. One scenario that we see moral hazard with, and it's been popular among economists, is do banks, or more so financial institutions, if they know that the government's going to bail them out, then do they have less incentive to avoid risky behavior. So, for example, if GM knows that the government's going to bail them out, do they have less incentive to engage in bad business decisions? And some would argue they don't, because if you know the government's going to bail you out, well, then why not go ahead and engage in some risky behavior? So, insurance costs a lot more than what it should because of these two problems in insurance markets: adverse selection and moral hazard. Let's go ahead and try these concepts out. Okay, identify whether each example is adverse selection or moral hazard. Joe begins smoking in bed after buying fire insurance. Well, he begins risky behavior after getting the insurance, so that would definitely be what? Okay, if you said that's a moral hazard, you were right. Both of Suzanne's parents lose their teeth to gum disease, so she buys dental insurance. Well, she's more likely to use it, so if you guessed adverse selection, you were right. When Gertrude parks her Corvette convertible, she doesn't bother putting the top up because her insurance covers theft of any items. So when she engages in risky behavior because she has the insurance. So if you said moral hazard, you were right. How we measure risk is based upon standard deviations. And this is a statistic that looks at volatility. And so what we do is we plot out the average of the volatility. And then this also goes along with something that I put on your Canvas site in terms of beta risk, or the correlation coefficient. And so what we do is we kind of use the idea of plotting out the average of the standard, and then we look at one standard deviation and two standard deviations from the mean to see what are the likelihood of these things happening. And again, the higher the standard deviation of an asset's return, the greater the risk. So one of the things that we kind of use from this is we say the higher the risk, the higher the return. So if somebody tells you that they have a portfolio that returns 60%, I can guarantee you that that return of 60% is at a huge degree of risk, that it might even be 6 or 7 standard deviations from the mean. So you probably want to go running because this particular return carries with it a high degree of risk. One of the ways that we can get rid of risk in the finance markets is through diversification. And the idea, or the old adage of putting all your eggs in one basket, really rings true here. There's two different types of risk that we have in the market. There is firm-specific risk and market risk. If we take and just invest in one firm, say Microsoft, then we're not only susceptible to everything that happens in the market, but we're also susceptible to everything that could happen to Microsoft. So by taking our investment and spreading it into several stocks, not just Microsoft, but also several stocks across several industries, and this idea is called diversification, then what we're doing is reducing the amount of firm-specific risk. So we can actually diversify away firm-specific risk. And the more we diversify, what happens is we can diversify away firm-specific risk. So through diversification, we can actually get firm-specific risk to zero if we do it well enough. However, we cannot reduce or even we can't even reduce, really, market-specific risk because all firms are traded in the market. And so things like the political, legal, the economic, competitive, technological, societal factors which impact the market itself and affect all companies in the stock market cannot be diversified away. So what you should know here is that firm-specific risk through diversification can be reduced to zero. Market risk, though, cannot be diversified away. And our next slide just kind of illustrates this concept. So, and this didn't come out real well, let me just draw this for you. And so what happens is if we diversify a portfolio, this portfolio, as we diversify stocks from small numbers of stocks in a portfolio to large numbers of stocks, what happens is the firm-specific risk starts to erode, okay, and we can keep reducing that firm-specific risk to a point. But then what happens is we still get that market-specific risk will remain regardless of how much more we diversify. So market-specific risk remains. Okay, so this particular slide just reiterates the concept of the riskier the risk-return trade-off. Remember, the higher the risk, the higher the return. So some questions you might ask yourself. Which is riskier, a U.S. Treasury bond or a bond issued by the government of Mali? So if the U.S. Treasury bond is paying 4%, and the Mali bond is, well, let's just spell Mali right. How about that? And the Mali bond is paying 10%. We know, based upon the risk-return trade-off, that the Mali bond is more risky, because the higher the risk, the higher the return. Be prepared to see some questions on the test that ask you about this concept. Okay, here's another example. Suppose you're dividing your portfolio between two asset classes, a diversified group of risky assets. So here, risky assets, our average return is 8%, standard deviation is 20%. Okay, so that's the average return is 8%, but our standard deviation is 20%, so plus or minus 20%. Here, a safe return of 3% with no standard deviations. So the risk return on the portfolio depends on the percentage of each asset class in the portfolio. So if you were looking at this, which one would you engage in? It's interesting, though, that many, taking a look at the diversified group, one of the things that we would see is it would depend on the age of the individual, it would depend on their income, socioeconomic status, and how long they have to earn back the amount of money in their portfolio. So when we look at this particular example, I would probably not put a whole lot of money in the diversified group of risky stocks. This would probably be maybe 10% of the overall portfolio, whereas the safe asset would be more like 90%. And I would use more of a buy and hold strategy in this particular example. Okay, so the trade-off between risk and return. So as we look at this, the idea of having no stocks versus 100% of stocks, look at how the standard deviation grows. So increasing the share of stocks in the portfolio does increase the average return, but it also does increase the risk. So going back to our previous slide, how would we take a look at this? Well, you could earn 3% and have no stocks at all, and just that really safe return in the bonds, maybe a U.S. bond you might have in that portfolio. Or you could have some percentages of each. Remember, I picked 10%. I picked pretty low, so I was like way down here. But you could go all the way up here. But look at the risk that you're encountering here. It could be up to 20% standard deviation, and that's a pretty high risk. So, it could be anywhere up to 28% that you might end up losing, and that's a pretty high risk-return trade-off. So, again, when you're evaluating how to diversify a portfolio, you want to take a look at a little risk is okay, but don't risk more than what you're willing to lose. Okay, thank you very much, and I look forward to seeing you for Learning Objective 3, Module 8. Thanks.